Is doing a 20% down payment necessary to buy a home, and is it the smartest plan? So, John, I mean, you're the lender here. So let's ask you: is that the smartest plan? Is that always the way it has to go?
This is Las Vegas Real Estate Now with local real estate expert Harvey Blankfeld.
Maybe, maybe not, and that's the
Right.
sucky answer, to be honest.
The answer is,
So it's the real estate answer of it depends.
My answer is, while 20% down is great, it's not necessary. You can do, VA loans with 0 down. You can do FHA loans with 3.5% down, or use a down payment assistance program. You can do conventional loans with 3% down and jumbo loans at 5% down and different levels like this. So 20% is nowhere near a requirement.
Right.
Subject to your ability to afford that payment and qualify for that loan.
Right.
But then I would suggest that people think about the larger financial picture when they're deciding whether they're going to do 20% down. If I'm a 23-year-old young person and I happen to have 20% available to buy a house, I have to then answer, okay, am I fully funding my retirement? Am I getting ready to open a business? Do I have other financial needs for that cash? If the answer is yes to those, then I would look to prioritize my money accordingly based upon that, because the penalties for not doing 20% down payment on a house purchase are relatively moderate and small in the long run. And your house goes up or potentially down in value at the same speed and dollar amount, regardless of what you owe on it. Right. So you're not creating additional wealth by putting extra down payment down. You're saving a little money in interest costs. You're saving on a mortgage insurance potentially. All those things are potentially true, but those can be small dollars compared to other large things to do, such as getting yourself out of other higher, more expensive debts, fully funding your child's college, fully funding your retirement. Those considerations, I think, also have to be mixed into the picture. What do you guys think?
Well, I think you answered that great, John.
Yeah, I think you have to pencil it out. Everyone's different. Everyone's unique. But here's the calculation in my head.
Oh,
here's the calculation.
He has his own calculation.
Is okay? Putting 20% down saves me on mortgage insurance. Is that savings? Does that outweigh the return on investment if I put that money elsewhere?
Yes.
That's the equation. That's the math you want to do. Is putting it in my child's college fund? Is it putting it into the stock market? Is it putting it into something other than my home going to get me a better return than the amount of money I got to pay to have less than a 20% down payment? That's really the math.
I think the other way you can look at it too is that the total payment I'm comfortable with right now, whether it has mortgage insurance in it or not, or I put more down. If I'm comfortable with a $4,000 payment, and that house I can get into that house at $4,000 and not put 20% down, then maybe allocating that money somewhere else is a better use of it.
Great point.
Yep, I agree.
Yeah.
And this fights agagst the Dave Ramsey school of thought,
right?
Where it's
Dave Ramsey doesn't like any debt.
Don't have any debt as far.
He's never been on the show, so he's
ironically,
ironically,
I mean, the people who build wealth build it by borrowing money for the most part. They do. I mean,
it's the multiplier effect of your dollars.
It is. It's the multiplier effect. So I mean, look, I understand Dave Ramsey. He's a smart guy, and I agree with him on something. But when it comes to buying a house, I think it's just too important to do it to worry about whether you own it outright or put a big down payment or not.
Let me connect this to one other kind of similar thought process. I get people who talk to me about mortgages and they're thinking, is 15-year mortgages the right play? Obviously, I pay a little bit or I pay some less of interest, and I pay off my loan so much faster, potentially in half the time of a 30-year mortgage, right? So the same for me, the same logic applies, except there's now a couple extra layers. So I have to think about, I have to pay so much more a month in order to be done in 15 years. Well, that's a long period of time. I would say the average American will have good years and bad years during that 15-year time frame. And so what I suggest to my clients to think about is, well, how about this? Instead of taking a 15-year right now, where you're forced to make that large payment every single month for these 15 years, what if I gave you a 30-year loan, but I told you what you need to be paying to be done in 15? Right? And now that lets you pay the 15-year payment in good times. And if you have a hot run and you go 15 years without having a problem, wonderful. You paid a little bit more in interest. But if you're a normal person who does have a bad year every now and then, or businesses change and things come and go, well, you have the ability to pull back to that 30-year payment through the lean times get through your rough spot, and then get back on track. So I like the flexibility that 30-year mortgage option gives you, especially when you're younger in life.
Is there any benefits of doing a 20 or 25-year term?
There, mechanically in the mortgage business, there are small benefits from a 30-year mortgage down to a 25, a 20, and then all the way down to a 15. There's a significant mechanical change that happens on a 15-year mortgage versus the others, where if I'm borrowing the money for 15 years or less, the risk pricing that goes into my mortgage is kind of mitigated or removed from the pricing of my loan. So let me make that more understandable. On a 30-year loan, your credit score has a large impact in the interest rate that you're given, the cost of your interest rate. Mm-hmm. In a 15-year, all of that impact is basically removed. A person with an 800 score gets the same price as someone with a 620 score.
Oh, wow.
When you're doing a 15-year mortgage, because those are so much safer and blah, blah, blah. Yeah. So there is some mechanical improvement to the pricing of the loans. So if I'm a person with a lower end credit score and I'm looking to get the cheapest possible borrowing, well, that would be a reason to go to 15 years. Once again, you have to look at your whole big picture and where you are in life. If you're a senior, let's say, or you're fully through your career, your kids are paid for, they're on their own, you've got everything's taken care of, your retirement's fully funded, then go ahead and pay that debt off as quick as possible as the highest priority. But saving a little interest and not considering all those other important things that make up a life is a mistake.